This is the Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoyed this episode. Thank you for joining us. Hello, this is Hall Martin with Investor Connect. Today we're here with Fred Gumbinner, President and Managing Partner of Keiretsu Forum. Keiretsu Forum is a global investment community of accredited private equity angel investors, venture capitalists, and corporate institutional investors. Keiretsu Forum is a worldwide network of capital, resources, and deal flow with 53 chapters on 4 continents. Keiretsu Forum members invest in high-quality, diverse investment opportunities. Fred, thank you for joining us.
Thank you. Good to be here.
Great. So tell us more about your background before joining Keiretsu Forum.
All right. Well, I was trained as a lawyer, went to the University of Michigan Law School, then worked at several large law firms, Chicago, Detroit area, and the DC area. Then I turned more entrepreneurial and was in-house counsel developing power plants, then branched off and started my own firm creating alternative energy products. It's mostly in the magnetics field. After that, I started getting involved with a lot of early stage ventures, combination of micro private equity, venture capital, special situation funding, just helping a lot of entrepreneurs and early stage businesses get going. So it became a great segue to get involved with Keiretsu Forum, which has a lot of similar interests.
And so what key strategies do you rely on to spot promising early-stage investment opportunities?
I served on several panels throughout the DC metro area, and that's a very, very broad question. There are a whole host of aspects that go into spotting a promising early-stage company. But as you asked the question about an early-stage investment opportunity, and that word investment opportunity is critical, because so many early stage companies could be fine and well as a lifestyle company, something that can work well to create a great income for the founder, owner, entrepreneur, but it may not be investable. There are a plethora of aspects that make something investable. I always I start, but when I give one of these speeches or lectures, point out the top 5 things that successful venture capitalists look at, when choosing good companies are management. Then after that, it becomes competitive advantage, market size and business plan. But even within those first 3 out of the 5 management, there's dozens of subcategories. So I'll keep this answer relatively short and end there.
Great. Well, as president of the Keiretsu Forum DC Metro chapter, how does your organization contribute to supporting and fostering innovation in the local startup ecosystem?
I and our chapter members get involved in a number of things regarding the DC Metro entrepreneur ecosystem. It really has developed substantially over the past 6 years. We get involved by partnering with various other organizations that are involved in the community and the ecosystem, whether it's local county development corporations, incubators, other angel groups, other capital investment groups, and the like. As I mentioned earlier, I also participate on numerous panels in the form of either Shark Tank situations and or just providing a forum where we have various topics that help educate entrepreneurs.
Well, in mentoring entrepreneurs, what are the key principles you emphasize to help startups attract investment and achieve sustainable growth in today's competitive environment?
Going back to the top 3 of the 5 criteria that successful venture capitalists look at, which is management, investing in the jockey, not the horse. You want to have a good horse, but a top jockey, on a B+ horse will usually outperform a B- jockey on an A+. So some of the things that I advise folks is to be open-minded with both your investors and your advisors. Take help when you can. Keep a focus on your target and objectives. and have an exit strategy and or liquidity event in mind as a target goal when growing your company. Don't fall in love with technology. Investors don't want to invest in science experiments. They ultimately are looking for returns.
Well, in your experience, what motivates investors to get involved in early stage investments? And what are they looking for in potential ventures?
Different investors have different goals. Some are clearly just looking for the angel returns, which as an investment category is the top performing investment category. If one has a well diversified portfolio of a sufficient number of diversified quality companies. So some are looking at returns, but a number are looking to get involved with the early stage companies. They want to be advisors, they want to be mentors, they want to help with the company. Others just get excited with the underlying technology and want to see that come about. So depending on the individual, it's a combination of not only the economic returns, but helping and mentoring young folks and or getting a specific product or solution out into the market and become reality.
Can you elaborate on the specific types of projects that Icon Finance typically supports and how your firm's approach differs from traditional early stage venture capital or project development models?
Sure. We are generally industry agnostic, and there's always almost more exceptions to every rule. But our basic model is providing, what I would call red zone capital. A company or an early stage company or developer has taken a project, to the red zone, past the 20-yard line toward the goal line, but needs that last push of capital to get it over the hump, in order to create a significant value enhancing milestone, such as a financial close to bring the large dollars to fully build out the facility or the project. We typically have many of our investments in the renewable energy space or waste to value. Part of the reason is we like to do good while making our, quite frankly, outsized returns. But because we seek and require outsized returns, it has to be a venture company that has sufficient profitability to pay our returns. We also provide assistance to help the companies get to their financial close or achieve their objectives. But in a nutshell, it's high margin ventures, hopefully ones that are doing some type of good and ones that we feel appreciate our investment and we can partner with to help them meet their business goals and our investment objectives. Part of the things that make us a little bit different is that we operate almost like the old time merchant bank, which source deals, structured deals, then put its own money in while allowing additional investors to join in. That's what we do. The principals at Icon Finance, we put our own cash into the money side by side with our investors. And therefore, we look at deals and opportunities that we clearly want to do for ourselves and then open up the investment to a cadre of other high net worth individuals and family offices. We're not a fund, so we present the opportunities on a case by case basis. But because we're small and nimble, we can do very creative finance stuff that traditional or institutional investment groups just can't touch. I can give one example. We financed the acquisition of a marijuana farm in Oregon. And not only did we get first security interest in the farm itself and personal guarantees, of course, we also had security interests in a restaurant in New Jersey and also a penthouse in New York City. No institutional entity, bank, finance company, et cetera, could ever even consider any kind of transaction like that. But because we're small and nimble, we can be creative in the structuring and how we collateralize the loan/investment and protect our venture.
And so, what advice would you like to share with our private equity investors and early stage entrepreneurs listening today?
Again, I could chat for hours on that. But some of the most important are recognize one's limitations. One cannot do anything themselves. It is, in my opinion, is key and critical to associate with other folks who can not only source the deals, and even structure the investment opportunities appropriately, but also have the ability, capacity to do sophisticated and disciplined due diligence. Because I think the number one reason that investors in early stage ventures lose money is due to the lack of due diligence. There's a number of things that enhance and improve the investment returns for early stage investments, one of which is due diligence. Additionally, is having some industry expertise or resources that can analyze the industry segment. Another is having regular contact with your portfolio company and entrepreneurs. I mean, that regular contact can be as simple as a monthly update call or as much as weekly calls and involvement. Other key things is to make sure that the management is willing to have goals that are fairly aligned with your goals. A classic example is, an early stage investors invest in a company that ultimately becomes multiple $100 million in revenues, but the founder has had all the power and kept funneling all the proceeds back into the company. Lo and behold, comes $1 billion company, but the investor still hasn't seen a penny back in return. So it had great paper value, but no actual cash return on the investment. So alignment of goals is important. And that's important for the entrepreneur also, because your question asks, about advice for investors and entrepreneurs. Sometimes they coincide, but sometimes, that they could be in conflict. So it's critical to make sure that the interests are as aligned as possible. I mean, one of the adages that some people say, it's worse to take the wrong money than taking no money at all. That can hold true, but when an entrepreneur is trying to raise capital, sometimes they don't look at it that way. Any check is what they need, but getting the right mix is important. And that's part of, one of the subsets of management, that the people that the entrepreneurs are coachable and folks can work together and appreciate the contributions that each are making respectively.
Great. So what advice would you give listeners interested in learning more about Keiretsu Forum or attending a meeting?
Simple. I'm not a salesman, so I'm not going to say Keiretsu Forum is the best, but it's clearly one of the best angel groups out there. Under most metrics, it's been in the top categories for the past half dozen or dozen years. Some of the critical things are because of Keiretsu's breadth and depth and experience, it is able to check the boxes on most of the 7 or 8 criteria that enhanced investors' returns. That includes, again, I don't have my list in front of me, so hopefully I can pull it off the top of my head, but some modicum of industry expertise, the ability to do real due diligence, the capacity for having diversified portfolio of types of companies, the ability to fully fund a venture, because one of the other advices I'd give to investors is never underfund a venture. That's throwing money into a black hole. The ability to do follow-on investments if that's needed, having regular contact or participation with the investment group. And I'm forgetting the 2 or 3 others, but Keiretsu checks off all the boxes in that regard, which, quite frankly, most angel groups that have, we'll say, under 50 people just don't have the physical capacity to do the level of due diligence and diligence reports that Keiretsu does. I guess one of the others is having exceptional deal flow, which of course we, given our vetting process in the Mid-Atlantic region alone, we get about 20 to 30 companies applying every month. We invite only about 6 to 10 to screen, and then only the quality companies that we think will get investment get invited to present. And that could be anywhere from 0 to 4 of those 6 to 8. So there's a significant vetting process that goes through before a company presents to Keiretsu Forum. And because of that, in the Mid-Atlantic region, we end up providing substantial funding to over 3/4 of the companies that present. And that statistic has held true over the past at least 3 or 4 years, even through the pandemic, where other folks, especially in 2023, 2022, 2023, really cut back on their investments because of our vetting process and our ability to negotiate good but fair term sheets. We've still kept our funding numbers throughout the pandemic. And simple ways to get involved is reach out to me or any Keiretsu Forum chapter president. My email is fgumbinner@keiretsuforum.net. That's FGUMBINNER at keiretsuforum.net. But one can also go to the various Keiretsu websites. There's both a global or national one and regional. Our regional one is keiretsuforum-midatlantic.com, and the national is just keiretsuforum.com. Both have a plethora of information. And the simplest way to get involved is to contact one of the regional presidents, and they'll invite you to attend one of the forum meetings where you can get a good sense of what Keiretsu is about. Plus, as I said, we have a plethora of materials on the websites, and we have a new member booklet, which gives a lot of information about us, what we do, and also what differentiates us. So that's some easy ways to potentially get involved.
Great. Well, that brings us to the end of our interview. We'll include your contact details in the show notes. I want to thank you for joining us today and hope to have you back for a follow-up soon.
Surely. Happy to do so. Appreciate your reaching out. Thank you.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.